Good morning. It's July 23, 6:10 a.m., Friday, episode 10. Good Friday morning to you, Wowie, and to each and every one of our listeners. It has been a roller coaster week in Wall Street as we celebrate the second billionaire whom has reached space. We also have some of the big techs reporting their June quarter earnings, and most, if not the most important news released this week is the National Bureau of Economic Research announcement that the United States is officially out of the recession. The
Yes. Woo.
COVID-induced recession or the Great Lockdown recession. More on that in a little bit. I hope you, our listener, have had a great week so far. And this is your host, Mark Yu,
And Wawi Santos,
and welcome to the Mark Yu and Huawei show.
good morning.
Disclosure, this show is made for sharing information purposes only and not to be considered investment advice. We record, me and Huawei, once a week. We are both physical therapists practicing here in the United States with the same passion and interest in researching and investing our hard-earned money in the stock market. The show's goal is to share and learn from each other, answer questions, and provide informed investment decisions or tips to our fellow listeners and coworkers in the medical field. And for those who are our colleagues, thank you once again, all of you guys, for your hard work. Remember, there's no one else that will walk that patient after hip surgery or cabbage aside from the nurses and therapists that carry doctors' orders. Just a brief recap, we are available in YouTube and Spotify and also in Google Podcasts. On our previous episode, we discussed the Federal Reserve's stance on the rampant inflation and the potential of it not being transitory anymore, the money flow in investments, big bank earnings, and their difficulty growing their loans, which is their primary income source, and the valuation of tech companies, how big they are. Of course, we mentioned when you combine Apple, Microsoft, Amazon, Google, Tesla, and Facebook, you'll get about a 10 trillion valuation. In addition, I and Huawei also discussed previously the dangers of sticking to old traditional investment point of view, such as relying on a company's balance sheet to arrive at an investment decision. And more importantly, we took a closer look at the super app of Asia, Graph. So for those who have missed that previous episode, feel free to go back and listen to it. In the meantime, thank you for each and every one of you for supporting our channel. Please hit the subscribe and like buttons. We truly appreciate each and every one of you. So on today's topics, we have what's up with Wall Street, market industries, the sentiments. We're going to add the Bitcoin sentiment as well, as some of the listeners requested. Also, instead of a regular stock pick discussion, I and Huawei will discuss the difference between IRA or individual retirement account and traditional IRA. We also have a couple of audio clips which are interesting from the Wall Street greats, Bill Ackman and Scott Minerd. Also, we're going to have the quote of the week. So let's head on and proceed. So for this week's topic, we have the second billionaire reaching the space, which is the richest man on earth,
Jeff
Amazon's founder,
Bezos.
Jeff Bezos. Yes. So he had launched in July 20 and reached an astounding 65 miles above ground. In comparison to Richard Branson flew back in July 11th, about 9 days prior, and he reached about 53 miles above ground. In comparison, both of them at least spend 4 to 10 minutes of weightlessness or no gravity at all in the edge of space. So quite interesting fact about these two in comparison, their flights is definitely Branson reached the space first before Bezos. But in terms of height, looks like there is like a difference between their height. Branson reached 53 miles, which is technically above space already as defined by the Federal Aviation Administration here in the US. But Bezos on the latter end reached 62 miles, which is far exceeds the Kármán line, which the Federation Aeronautic International, or an international record keeping for aeronautics, sees as the edge where the Earth's atmosphere meets the outer space. So quite technical there, but you can see in this chart or this picture, the drawing where in comparison from Branson's flight and Bezos' flight. So as mentioned earlier, we have finally had an announcement from the official documenter of economic cycles. They released this on July 19th, which was Monday. The National Bureau of Economic Research said the contraction, as you can see here, a contraction lasted just 2 months from February 2020 to April 2020. That's so interesting, Wowie, because usually you would see a contraction would occur for at least a year. But as I was going through this last night, I was reviewing and I'm like, just 2 months? Really? So it's from February to April 2020. And it took him at least a year or more than a year to announce this. What do you think about this, Wally?
I think our economic market is like in a time warp, like everything is compressed, everything is happening so fast,
right?
That things are so volatile and changing so fast that I think you can compress a recession in a couple of months, maybe even in 1 month or 1 week.
That's incredible, right? Like it's such a short time period. And I think we owe it because of the Fed, right? They fully supported the economy during the lockdowns.
Mm-hmm. Well, you also have to think that technology is around. You have Robinhood, and you have a lot of new retail investors using new technology platforms to invest. So the movement is fast. So if these new technology platforms available for retail investors are in hyperspeed, what else are the big companies using? These market makers, what are they using? To complete transactions. They are fast.
Yes, and I do think because of the early adaptation of the administration providing stimulus checks to everybody helped the consumer at least bounce back up. So interesting, some charts here, even though that we are technically, as announced by the NBER, out of the recession, as of April, we were still like, this is a year after the recession period that was like determined by NBER. We were still at an employment rate of 6.1%, which is very high compared to the low 3% prior to the COVID. And also, yeah. So what's interesting about this is Jay Powell have stated something on unemployment. He said that the current unemployment rate provides an incomplete picture rather than indicating like people struggling or the economy having a hard time catching up. It doesn't provide the complete picture in terms of progress on the health of the job market, because many workers, he said, remain sidelined for a variety of reasons, including health concerns and mothers at home with children who are home from school. He said that, quote unquote, the committee decided that any future downturn of the economy would be a new recession and not a continuation of the recession associated with the February 2020 peak. So I think with the employment rate of 6.1% or still about roughly 10 million unemployed, NBER announcing that the recession is over. Moving forward, as long as the consumer sentiment is good, consumers are spending money. Like what we said, technological adaptations, order via the phone, people still kept spending money. So US economy just keeps on humming. In any event, looks like we are out of recession officially, according to NBER. So here we're looking at the markets as of yesterday. S&P 500, Dow Jones, and the Nasdaq are just 0.5% away from their record highs. This is just incredible. I can't believe that we're this close again to record highs, Swami, because just back on Friday and Monday, we've been just right after we recorded our previous episode, the markets were actually falling, like dropping. But after ensuing days, Tuesday to yesterday, it looks like the market has recovered.
Yeah, the three indexes are doing really well.
Yes.
So there's an uptrend.
Yes. So as you can see here, from Friday down to Monday, the market actually dropped about 3%. but in the ensuing days, it actually bumped back up and now it's within cusp of new all-time high. Look at this screenshot by Kramer on his talk show, CNBC. He was saying that there's the end of euphoria coming soon. This is back in Monday when everything else is dropping. So he
That's why
said
he looks grumpy in that
he, loo-
picture.
he looks grumpy. For our listeners. Kramer has been around the Wall Street for so many decades already. I would say 2 decades, and we like to poke fun with him, but he's a good one. He said here on his screen that there's too many IPOs, the meme day pumps, micro cap craziness. All of these indicate that we're close to an end of euphoria. So it means that it's about to correct, or sometime soon, maybe the market would react negatively because of all this hype. So just to recap, the chart that sunk the market Friday and Monday, as in my opinion, is this one, the U.S. Michigan consumer sentiment. As I have said a previous podcast, that U.S. economy consists of mostly consumer spending, like 70% at least, in my opinion. So it dropped from consensus estimate. This is released at least once a month, down to 51%. Or not 51, sorry, 80 to 81% from the previous month of 85%. So a little bit of drop takes a lot of brings a lot of fear in the market, at least temporarily, as we have noticed. And also likewise, the impact of the ongoing Delta variant of COVID. As you can see here in this chart, COVID cases in major countries, developed countries, United Kingdom, European Union, United States, and even our beloved Philippines has experienced uptick since July, start of July, which is a little bit worrisome. Here in the US, we are seeing a lot of increases in COVID in Maine, Mississippi, Oklahoma, and Arizona, which are going at least over 100% in a week-to-week basis. So that's a little something to watch out for. For the sectors this week, we are still showing some sector rotation, money going into technology, money flowing out from financials and energy. So as Wawi and I discussed, financials and energy, these are the reopening plays. But so far this week, we've been experiencing more love for technology, compared to the reopening stocks. This is despite the banks, as we discussed last week, that they have met expectations and actually far exceeded some. So look at the industry here. We are seeing that the energy sector, despite their poor performance for this week, is still up 28% this year. They're the highest performer compared to the financials. Financials are up by about 16%. And in comparison to the NASDAQ and S&P, which are near all-time highs, both of which are still at the 15-16%. Just to imagine if you kept all of your hard-earned money in savings. This is discounting the fact that you already have your emergency savings. You would have missed this incredible rally. When we take a closer look at this, as I've dug in a little deeper last night compared to the bonds, because what was the Wall Street was just saying that the bonds are falling, lowering yields, it'll affect the banks. So I did the chart comparison, banks compared to the bonds, 30-year bonds specifically, like it does indicate some correlation here. As the bonds are going down, financials are going down as well. So far in the past 3 months, since May 2021, the bond rates have fallen at least 14%, while the bank industry or the index as a whole had fallen 7%. So if anything, if the bond rates, 30-year bond rates still keep going down, there's a big chance in my opinion, banks would follow through, because that's how they make money, through higher yields. And looking at it from since January 2021, it does look like they're very correlated. The bond yields, the 30 bond yields and the banks. The higher the bond yields go, the better it is for the banks. The lower the bond yields go, the less profitable banks are. So one contributory to this, I think, is because of the Fed's quantitative easing. They don't term it that as that, but I believe that's similar, or that's the case. Its balance sheet, total assets have been climbing through the roof, and this is by the billions. So you can see here in this chart. For our listeners, don't worry. I'm just showing a Fred chart here of the Federal Reserve balance sheet. We're now at 8.1 trillion, a nice sharp increase since the COVID lockdown.
I got a question, Mark,
Sure.
about this. This Fed buying. So
Mhm.
when they start easing off on their buying,
Yes.
so they're gonna sell all these stocks and bonds that they bought back
Mhm.
into the market. Who do you think will buy it?
I think a regular investor would still try to adapt to it, try to diversify. Because at this point of time, in my opinion, people or the big hedge fund managers and money managers are very exposed to tech nowadays. Because as we've been discussing previously, money has been rotating out and it being invested over and over. Like there's a massive flow going into stock market. So right now, the Fed is definitely supporting the economy through buying bonds, 120 billion per month. That's just incredible supply and demand provided by the Fed. So hopefully, I think
Mhm.
the Fed is slowly communicating that to investors. They've
And
been. Mhm.
I think they need to keep the retail investor sentiment
Right.
positive
Uh-huh.
once they start changing their strategy.
Mhm. Definitely, because that will definitely impact the markets. Just remember, guys, back in March 2020, when the lockdown started, everything else went through the window. Like the sky was falling day after day. The index were hitting their circuit breakers because a lot of people were selling. So we don't want to experience that over again. But if we do, well, you know what to do. We just have to close our eyes and start buying a little bit more. Pull out some savings and buy. So speaking of sentiment, Wally, looks like as of yesterday, the American Association of Individual Investors Sentiment, it registered a downtick again. So people are getting less optimistic since the end of June, which is very interesting, despite the market hitting another, close to all-time high records. So I would say, in my opinion, that this bull rally or bull market that we're in is becoming even more frustrating, I would say, for those people who are still on the sidelines waiting for a big pullback to go in. I think the sentiment is just reflecting that. Like they are getting frustrated because the market is getting higher and higher. And it's hard to predict where the market is going. So 714, day before our previous podcast, the sentiment was actually already down from 40% to 36%, the bullish sentiment, those who think that the stock market will go up. And as of yesterday, it went down further 6% to 30.6%. So I don't think the investors are able to ride this bullishness of the market, at least the recent bounce. And the bearishness or the negativity, the opinion of the investors are ever increasing from 26.8 last week. Now it's up to 30.6%. So this is close to going down here at the historical average. People are definitely less bullish, but just equal to in terms of being bearish. So we're still not on that panic mode, as I would say it. The fear and greed sentiment. It says here investors are on extreme fear, believe it or not, with the markets closing in near record highs.
Uh,
Extreme greed over time is definitely has declined. We're going to the fear or negative side.
well, I'm thinking it may have something to do with the Delta variant
Mhm.
increase of cases here in
Yes,
the US and all over the world.
I think that's a good point right there. Because of the ever increasing cases, people might probably start pulling back a little bit but the market, nobody can tell where it's going, but now it's just closing into a new record high. So
Because
looking
you
at
have you have two things kind of doing the tug of war here. You know, people do want to invest, make some money, but
right,
you get negative news about the virus spreading, and then the supply demand issue,
right,
still not normalized,
yes,
tend to slow things down. And we're still somewhat in the process of opening businesses. Small businesses are still, I mean, they're improving, but they're still struggling finding workers. So I have a friend, she owns a restaurant, small business restaurant, and she's still having problems finding workers.
oh yeah. So the
Yeah.
worker demand is still there, but to fill them in is a challenge.
Yes.
I see.
Yeah, that's a challenge for business owners.
Right. And our next discussion here is like an example of sentiment as well, a play on sentiment. I'm looking at Kathy Wood's ARK investment. So far this year, it's trading underwater, negative 2% compared to the S&P 500. So despite the people rolling into tech or high growth companies, there seems to be a neglect to the ARK investments. I'm not saying that this is a good buying opportunity, but certainly an interesting thing to look at because, correct me if I'm wrong, Wawi, I know Kathy Wood's is highly focused on high growth companies. So if people
Yes,
would,
she is.
if you're really looking forward to being exposed to the tech side, I think it might be an interesting thing to look at ARK's portfolio at this point in time. But I think they're still very heavy in Tesla. They won't let go of Tesla.
And Bitcoin.
And Bitcoin. So yeah, we're gonna go into Bitcoin a little bit. So while here's the volatility index for the past 5 days, it's up by 5%, not so much. But if you're gonna look at the Friday spike, this is during the sell-off last Friday, it was up 41%. And then it continued further. So it went up 41% and it rose up to 36% higher from actually from 18 points. It rose up to 24.8 points as of Monday before the market closed. I think that was a peak panic. And then Tuesday, we saw the tide receding, and then slowly it went down throughout the week. As of yesterday, it was down back to 17. Volatility has subsided in the meantime. So one of our listeners requested if I could do a fear and greed sentiment of Bitcoin, because we've been doing market sentiments throughout our podcast episodes. And I saw this timely being updated. The fear and greed sentiment in Bitcoin, not so much difference, interestingly, compared to the stock market. Now we're at extreme fear as well in Bitcoin. For the past month, Bitcoin has been performing relatively steady, negative 4%. But the most interesting thing is back in April, we are trading at $63,000. Now it's down to 32,000 or 50% down. So that's quite a big dip. Hopefully no one in our listeners have bought the peak in this crazy switch in terms of fluctuation, price inflation. I mean, yeah, price movement, as I would say it. So another interesting chart here is a Bitcoin, because some of the Bitcoiners, as I would coin them, said that it was a good inflation. There's a recent article here. It said that Bitcoin is failing its first inflation test as sell-off deepens. So as you may know, me and Wawi discussed last week that inflation has hit 5%, which is the highest in 13 years. Everything from food to gas to used cars to houses, everything is climbing up. So people are saying if you bought Bitcoin, you would be able to prevent from losing money over time. But as reflected here, there's a price comparison between gold and Bitcoin. Bitcoin, as of its previous peak at April, is down 50%, as we have mentioned, while gold has become relatively steady. So it's interesting how Bitcoin can catch up to this sentiment that they're an inflation hedge compared to gold, which is, I would say, a more relatively steady, not income producing, but definitely being a, if you want to be able to conserve your money against inflation, it provided a good, relatively steady investment for the past couple of months. So it's earnings week, as me and Wally have started discussing last week, banks. And this week, there were countless reports, definitely countless reports. So we're just going to go through a couple of companies here. Um, Netflix definitely has reported their earnings as of June quarter. For the 3 quarters, actually, they reported a little bit down, not meeting Wall Street expectations. As a result, their stock price slid down. About now they're down at least 5% for the year compared to, I would say, the S&P 500, which is up 15%. The primary reason is because Wall Street was expecting more growth in the coming months. Wall Street was expecting for Netflix to say that they're going to add at least roughly around 6 million more subscribers in the next 3 months of the coming 3 months of this year. But they instead said that they're going to be adding at least an estimated of 3.5%. So that kind of dampened the expectation down and setting one of the FANG components down a good amount. But interestingly, globally, as I've reviewed their report, Netflix actually added 1.5 million net new subscribers in June quarter. They were expecting at least 1 million. So in terms of their internal estimates, Netflix actually beat their expectations instead of not meeting them. And in comparison, you would see here, they currently have a total of 209 million subscribers still. That's a huge number. Let's just say compared to, let's say, HBO, AT&T HBO Max, which has a total of 12.1 million subscribers. So Netflix still is generating cash flow, which is good overall. And you can see here their report publication. The chart for our listeners, no worry. You can see here the spike. 2020, since the lockdown, definitely showed a trajectory, a big jump from their 2018, 2019, 2017 net additionals of paid subscribers. But here in 2021, you can see there's some slowdown, but it's still trending up. So overall, I don't see anything wrong with Netflix at this point of time. They're still gathering new subscribers, albeit a little loss of subscribers here in the US. They reported 430,000 subscribers drop in the US and Canada during the June quarter. But overall, they were still able to add 1.5 million worldwide. And you think, Huawei, this will just keep on going with Netflix being able to add their subscribers?
Well, it's gonna compete with Disney,
right?
And between the two of them, they have to duke it out with quality of shows that they're offering for their viewers. Netflix has more of an international appeal. You got a lot of different productions that are made internationally, so it depends on your taste. I think Netflix has more variety than Disney, but Disney has more quality movies
like the Disney storytelling behind their characters. Definitely Disney brings it better and closer to life, I would say, because Netflix has just started to initiate selling some of their products. I think some of their related to their shows compared to Disney, which already they already made their studios. People pay good money to go to their studios.
I think if you invest in both, you're still gonna come out ahead,
right?
Because it would be a surprise if they merge.
Yeah, there definitely is gonna be a critical view there by the governments around the globe. But yeah, as I was comparing earlier, I think it's apples to oranges to compare Netflix with AT&T's HBO to begin with, because AT&T's HBO, even Disney's Disney Plus, those two are only available here in the US, but Netflix definitely, as what we have said, it's worldwide. It's available worldwide. So jumping on to our next, it's Chipotle. So restaurants have been reporting their results, and this is just incredible, Wawio. As I checked this out, I was astounded.
Mhm.
Chipotle, and, not so much long time ago, Chipotle actually, June 8th, when Chipotle actually stated that they've increased their prices across the board by 4% because they were now paying much more for their goods, and they raised their minimum wage to their workers to $15 an hour. But nonetheless, their stock jumped to all-time highs as of yesterday. They're up 30% for the year because of the wide reception that the customers or US consumers have shown to its burritos and products. Its CEO said that Chief CEO Brian Niccol said that there's a growing momentum for their products through drive-thrus or online orders. So, as a brief recap, Chipotle's earnings back before pre-pandemic 2019 was 249 million. During the same period in the pandemic, June 2020, this is summer of last year, their earnings jumped by 2.5%. This is during the time when everything was locked down. Their profits jumped 2.5%. And then June of this year, their profits jumped more than double, 129% to 586 million. And they're as profitable as ever. Their operating margin is now 24.5%. As I would say, they're collecting 24 cents in a dollar per dollar of revenue, which is double also as well compared to last year. So that's just incredible growth. Domino's also just reported, and impressively, they reached another all-time high, similar to Domino's. So Domino's, for a trivial fact, they just opened their 8,000th outlet store earlier this month. And Bill Ackman, as we're going to jump on next, also known as the Baby Buffett, or the chief executive and founder of Pershing Square, had taken a 6% stake in Domino's Pizza. So this just shows that one of the Wall Street greats think positively of these fast food stores. Domino's pre-pandemic earned 92.4 million. During the pandemic, their earnings jumped 28%. And interestingly, this year, although their stock is all-time high, investors like their stock, buying them, their profit actually dipped 1.7% to 116 million from 118 million last year. So that's an interesting contrast. The Wall Street is celebrating that fast food chain as a sector are beating and beating expectations. But taking a closer look at Domino's, not so much of a flamboyant exhibition compared to Chipotle's incredible profit growth. So we're on our next segment. We're just gonna play a clip from no other than the Baby Buffett himself, Bill Ackman. This is an interview on Monday when the markets were going down like crazy. As you can see here, Dow futures point to 500-point loss. This is before the market opened. It gathered at least 42,000 views, 42,700 views, and this is an insight provided by Bill Ackman. Let's play the clip.
And both the inflation that we are seeing, maybe some of the supply chain issues that are creating some of this. The big question is this the new normal, or is it transitory?
I'm in more of closer to the new normal with respect to many sources of inflation. So one, I think inflation's understated. There's very, very significant and they talk about home equivalent rents or ownership equivalent rents And those are really understated. If you look at what's going on in the housing market, we have a housing boom. Talk to a home builder, there's everything's is on allocation. You have to, I have a friend who knows the CEO in order to buy a home. So you're seeing housing prices go way up. I think the way the data is collected for the kind of CPI or other inflation numbers really understate what's going on in housing. That's approaching a third of inflation. So there's housing inflation, there's real wage inflation. One of the big issues, and I think this is not a transitory thing at all, which is recruiting. Trying to get people to come work in a hotel, work in a restaurant. I think it's harder now because of some of the stimulus. I think it'll be a little bit easier come September, but a lot of people made sort of life choices and various things. I think you're going to have to pay people to come to work, and I think that's actually a big positive, probably a long-term positive for the economy. So you've had $5 trillion in stimulus, you have an increase in wages, you have a lot of savings, you have the stimulus of a lot of people being vaccinated around the same time. All these things lead to massive, massive economic growth and demand, and we still have an extremely accommodative Federal Reserve. So I think rates are going up. I think rates are going up.
Yep.
So that's a clip from Bill Ackman's recent interview. So as you see, I've been saying these words, Baby Buffett. So the reason why this is even before, like he made the most, like I would say, one of the best ever trade in Wall Street during the pandemic. Like he turned a 20 million bet. You remember that, Huawei? He turned a 20 million bet into over $1 billion in profit because he was on the right side of the trade during the lockdown. This guy takes his craft seriously, and he definitely runs Pershing Square. And investors have benefited from it. And before we provide our opinion, Huawei, I would like to, in contrast, play this interview, which just happened, I bet, just 2 days ago. This is a couple of days after the interview of Bill Ackman. So this is Scott Minerd. He is the Chief Investment Officer of Guggenheim Partners. In a little bit, you will see how much money this guy commands under his belt. So it gathered a little less views, 2,700 views, but it's important for us to hear, in my opinion, to hear what he just said in a recent interview, sharing his insights about the stock market.
Speaking of entry points, if you're concerned about a risk-off summer, you see problems ahead for stocks, how much do you expect them to sell off and when?
Well, Sonali, I think that we should really focus on the later part of the summer. Usually the stock market has its weakest performance in the months of September and October. There's the old rule, sell in May, go away, come again at Labor Day. Statistically, it's actually been shown that selling around Memorial Day and buying at the first game of the World Series is when is a good entry point for stocks. So I think September and October are likely to be very rough this year. Maybe a pullback of 15% or slightly more. But once the Dodgers are at the opening game in the World Series, I think you'll be able to buy it.
So what do you think about this, Huawei? One guy is actually saying that there's going to be a massive economic boom, while the other guy is saying that there's going to be a pullback in the September-October months.
I don't know. I think they're saying the same thing. What's the second guy's name, Mark?
Scott Minerd. He's a chief investment officer of Guggenheim Partners, which currently has about $270 billion in assets under management.
Well, he's got he's got the pattern down, sell in May, go away. So it's looking at more of a short term, view of the market.
Exactly.
Bill Ackman, I would say, with his statement during that interview, is more sensitive to the current economic situation. So like I was saying, it's hard to find workers right now because you still have they still have money, right? From the stimulus. And this is what I was telling my friend that owns the restaurant. And I said, eventually people will use up all that money and they will have to find work. So I think a lot of the stimulus will stop in September, right?
Mhm.
So that's where Scott is right.
Yes.
So expect things to maybe go down in September because people will run out of stimulus money at that time.
Mhm.
There's still talks about child tax credit coming in
Right.
this month, so there's still going to be money for those that have children,
Mhm.
so that will support them along the way.
Right.
But we're in the later part of July, so we got about a month or so before we expect some more rotation
Yes.
in the market.
Definitely.
But
Mhm.
I would look at it again as an opportunity. Just don't do anything. If you're a long-term investor,
Mhm.
and just look at the trend.
Stay in the market.
Yeah, so I would look at, I would put it on my watch list. These oil companies.
Mhm.
Watch out for more drilling, hopefully, because they're gonna start hiring people again. There's shortage in the trucking market.
Mhm.
Construction, definitely construction. Look at construction.
Right.
That's still gonna be a busy season for construction.
Right.
That time of the year,
Yes.
in
So-
my opinion.
Yes, I think I totally agree with your opinion, Wally, because Baby Buffett here, Mr. Ackman, who's worth billions and billions of dollars, see a positive side of the economy recovering despite the
Mhm.
ongoing Delta variant. We didn't play it, but the earlier part of that long interview, he was saying that the rampant increase in cases would encourage more people to get vaccinated. As a result, we develop a immunity hopefully in the near future, and it will propel our economy to new highs. Well, Scott Minerd, I think it's unfair to compare these videos because one is being asked if he thinks there's going to be a pullback. So definitely he said what he's thinking of in terms of a short-term performance, which can occur anytime soon.
Mhm.
I mean, he could say September, October, but for all we know, it could be today. The market could drop by the open today. So he's just providing his insights and his experience. So,
But
Mhm.
but what we're seeing right now, the pattern that we're seeing is like it's up and down. So there's a lot of fluctuations.
Exactly, and volatility indicates
Mhm.
just that 5% up.
So if you aggregate your chart, you're still gonna see a level, a leveling. I mean, it will go up, it will go down. But if
Right.
you average the whole thing this past 3 months, it's just level.
Right. Yeah. Overall, over time, stocks do go up. So
It should.
hopefully so. So just in contrast, we're not going to play any more clips, but this is a page of a famous YouTuber with a 3.3 million subscribers, and I would say you could tell by the screenshots here, it's like it's end of the world almost each and every time.
Oh yeah.
I'm a follower, but it's hard. If you keep on thinking negatively about the market, you're probably not able to invest at all to begin with. So every time the mother of all crashes is coming 3 weeks ago, if I scroll down why I'm selling, the stock market just flipped. So I would say it's really hard to predict. It's just a game of mindset. I would like to share a quick quote from one of the not one, but the chief investment officer of Bank of America. His name is Chris Heisey, or Heasy. I'm not sure how to pronounce the name. He said, for a long-term investor, success means being consistently good rather than occasionally great, following a strategy based on your personal goals. So definitely write down your goal if you're going to invest in the stock market before you engage in different sorts of like investing, making your own investment strategy. That way you don't get sidetracked or get tempted to join the latest craze. Because if you did join the ride on Bitcoin back in April, this Bitcoin is not part of the stock market, but it's an investment vehicle. You could have lost a lot of money. So I'm just saying, just putting that out there. So on our main topic, the difference between 401k and the individual retirement account or Roth IRA. So I pulled up here, the Investopedia but we're not gonna read through this. I'm just gonna share what I've learned as I was reading through this and in my experience, and we're gonna share our opinions later on. So just information to our listeners: 401k and Roth IRA are investment or retirement vehicles. 401k, you can treat these both as like a savings, as a nest egg, a literal nest egg that you can hatch later on when you need financing in your later life, and that you're no longer able to work and you want to spend, or in other case you just want the rest of your retirement time spending. This would help with the expenses, so you can treat them as both as a nest egg. So 401k, this is not your personal retirement account. It is savings maintained by the company you work for that sponsors a retirement plan for all its employees. So you typically, when you're employed, you get to be offered, if you want to sign up for one, a 401k, and typically they match it. Hopefully they match it at a certain amount. Before they actually match it 100%. If you can find a company that will match it 100%, that will be great, because it's like doubling your money passively, literally. And usually these accounts, 401k, are accounts that are being managed sometimes by Fidelity, or those big institutions, State Street or Vanguard. There's a contribution limit for 401k. You can contribute up to $19,500 a year to your 401k, and if you're age 50 or over, you can contribute up to $26,000 a year. So the match doesn't include or doesn't count toward the limit. So the employer match 100%. That's like doubling your money, $20,000 plus $20,000, $40,000 a year, if you religiously put money aside in the 401k. It constitutes to about $1,600 a month, excluding any employer match. So 401k. So for IRA, or individual retirement account, or Roth IRA, it's your own personal retirement account. So 401k, it's not your own personal retirement account. Your company provides that. You get to use it, take advantage of it, but you cannot actually decide specifically where the money is going. You can probably dictate, like, some options there being growth or what, but it's not like you can decide what or which specific stock you want to invest using the 401k account. You don't have access to that. IRA, on the other hand, or Roth IRA, it's your own personal retirement account. It's tax deduction during contribution or accumulation period, up to 59 and a half years old. So it's similar to the 401k in terms of the period during which time you're building your nest egg, and the funds that will be taken out by the time distribution happens during retirement will be taxed. This is the IRA, the traditional IRA. So just a refresher. So now we're discussing IRA. Earlier it's 401k, now it's IRA, and IRA has two parts, two different products. One is traditional, one is Roth. So traditional IRA, you don't get taxed during the accumulation phase. So you get to invest more in the traditional IRA, but you get to be taxed on a later period by the time that you would need the money or start the distribution phase. Roth IRA, on the other hand, you get to be taxed during the accumulation phase. So by the time that you need the money, by the time that you retire, or when you're eligible to start collecting your dividends or distributions, by the time of 59 and a half years old, you don't have to worry about the taxes that would be taken out, because you already paid it during your accumulation phase. So hopefully
that's correct.
So hopefully that goes clear with our listeners.
And I think
Mhm.
I think it's good for our listeners to consider investing in both
Right.
401k or traditional IRA and Roth IRA.
Mhm.
We could call Roth IRA as a tax advantage account,
Right.
because it's pre-taxed, and when you withdraw it, you don't get taxed. And
Right.
don't forget, you can invest in regular stocks if
Right.
you have your own individual Roth IRA
Exactly.
or traditional IRA.
Yes. For yeah, I agree with that. The IRA and Roth IRA would allow you to pick your own stock companies or whichever fund you want to invest in, or ETF. And for contribution limits, IRA, or individual retirement account, has a limit of up to 6,000 to 7,000, well, 6,000 per person as of 2021 per year. That's about $500 a month, and up to 7,000 if you're 50 or older, $7,000 per year. So if you're married, you just double that. It's going to be six to 12,000, and then 7,000, $14,000 per year. As a result, like Huawei has advice, I would say, I would definitely agree that contributing to both, if you want to make sure that you have a nest egg in the future, would be rational. You'll be able to take advantage of the tax purposes, because these are like tax beneficial to those who are looking into investing in the stock market, as well prepare for their retirement.
Yeah, so something that you have to think about is, by the time you're, different decades in your lifespan, according to some experts, you have to have some savings
Right.
already in any of these retirement accounts.
Mhm.
So they said by the time you're 30, you should have at least 3 times your salary saved up, between that age, 30 and 40.
Right.
And by the time you're 50, you should have at least 6 times your salary,
Right.
saved up.
Yeah.
And by the time
Uh-huh.
you're 60 and ready to retire in a few years, you should have 8 times your salary saved up for
Well,
the current situation.
8 times, and that's also including the fact that inflation is ever slowly increasing over time. So that will be definitely beneficial in the long term.
And people have to think, that the stock market reflects inflation. So if there's inflation, we're all worried about inflation. But if you look at the graph of the stock market, the 3 indices, it outperforms inflation.
Right. Over time, it does.
Over time,
I think there's a study of during the mid 90s until as of last year, despite the pandemic, average stock market indices has returned at least 7% a year over time. So I think it's a safe bet, as long as the inflation won't be reaching like crazy 10%. I think we're good of our investment strategy at this point in time.
But correct me if I'm wrong. I think right now we're more of like a stagflation, right? Because
I'm not in any particular calling any stagflation or inflation, but at this point in time, we're still leaning towards more inflation. In my opinion, I think. But stagflation is definitely one thing to watch out for. Stagflation doesn't do anybody good because there's no growth during stagflation.
That's what I'm seeing. There's no growth right now.
In exception of I guess the products that are being sold in the market. But yeah.
Well, so if the Fed starts easing off, pulling back. So what do you expect from your analysis?
I would hope that people will start going back to work and maintain somewhat of a steady demand in consuming, because that would definitely harm the overall sentiment, not only for the spenders, for us, residents here in the US, but it will also harm the demand if there's a big slowdown in consumer, which we kind of like already saw last Friday in the consumer sentiment report. So if that turns out to be accurate down the road, especially like what Scott Minerd had said, like back in September, there could be a pullback September and October. At the same time, you've pointed out, Wowie, that there'll be a lot less stimulus coming in. That could be a worrisome picture right there.
Yeah, so it's highly dependent on consumer demand.
Yes. So, yeah. Going proceeding to our next segment. Do you have any quote of the week, Wowie?
Yes. Yeah, so I'm gonna pull from a Buddhist monk. His name is Thich Nhat Hanh, and I'm sorry if I'm not saying it correctly. So what he said was, time has much more value than money. Time is life. Money is nothing compared with life. In 2 hours of drinking tea together, we don't get money, but we do get life. So basically, I think he's just trying to remind us, not to be obsessed about, money, but kind of enjoy life along the way. We all need money to survive, and it's good to have it. It gives us some form of security. But I think we have to continue to establish friendships and,
Right.
as much as possible, be productive members of our community. As physical therapists, I think our jobs, kind of set us up to be, to be that way. But we can do more. We can always do more.
Right. It's all about priorities. If you're not prioritizing, or if you're prioritizing something more than the other, then your balance of weighing things out could,
Yes,
it's
that's
hard.
I think that's a good word to use, balance. You have to balance everything out,
Just
or
like-
else you'll be leaving something behind,
Right.
and it may not be a good experience.
Right. Definitely something to keep in mind through our daily tasks, and not lose
Mhm.
track of who the important people are in our lives. That's a really good quote. Well, we appreciate that. So,
I
okay,
think-
guys.
Can-
Sorry, go ahead.
I think I want to say another thing. This is like a phrase that was mentioned by Elon Musk. So before he had his birthday, he was asked what he's gonna do for his birthday. So he said he definitely wants some techno music, and he said techno music makes him feel like maximum human. So something about that, right? So I like that term, maximum human. You feel human, because you can, have fun, right?
Yeah, probably
So-
take time, sit down, just think about things, priorities, gauge yourself if you're over tilting to one end of the spectrum compared to the other,
And
And,
have fun.
and have fun for sure. Well, I appreciate, yeah, that quote is really makes more sense as we think about it more and more. Well,
Mhm.
for next week, me and we will be back, and we're gonna take a further deep dive in the big tech, because Twitter and Snap already reported their earnings yesterday, and they are blowouts. So we're gonna definitely keep an eye on Google, Facebook, Amazon. Your favorite Huawei, Tesla, is coming out with its earnings next Monday.
Yes, Monday.
Monday, big day. And then McDonald's, let's see if McDonald's report good numbers next Wednesday compared to Chipotle and Domino's.
Well,
Huawei-
for next week, I
Yes.
think I'm gonna try to look at Airbnb again.
Okay.
Review Airbnb and Bumble, right?
Okay.
So
we're gonna take
Bumble
a,
got back into my radar.
Mhm.
So
okay.
those are my two buys yesterday. I bought Airbnb and Bumble. So we can also look at that
Yeah, we're gonna
next
take a
week.
closer look on Airbnb for sure, because I'm also exposed to their Airbnb just for a low percentage in my portfolio. So, well, Huawei, thank you so much for coming in this morning, listeners.
Thank you.
That does it for this episode of Mark You and Huawei Show. send your questions. Or if you just want to say hi, send us an email at markuwawishow@gmail.com or tweet me at marku_DPT. Remember, build that emergency savings and invest the rest for an abundant retirement. Once again, this is Mark Yu signing out.
And Huawei signing out.